Hello, everyone, and welcome back to this week's Money and Market Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in global financial markets for this week and beyond. Today is Tuesday. It's March 1st. I'm Mike Bernick, and joining me today are Mike Larson, Larry Edelson, Kathy Lean, Boris Schlossberg, David Dukevich, and Mandeep Rai. All right, let's go ahead and get started with today's Squawk Box. Well, February was another volatile month for financial markets globally. In fact, global stocks fell for a fourth straight month during the month of February. That's the longest losing streak for global equities since 2011, as a matter of fact. So the volatility continues with zero interest rate environments in part of the world and sub-zero interest rates environments in Europe and Japan, and of course the Fed is still on track to raise rates with another meeting of the Federal Reserve coming up in just 2 weeks. Mike Larson, what do you make of the cross currents here in the markets?
Yeah. Thanks, Mike, and good morning, everybody. When I look at a lot of the indicators that I follow, I still see several of them kind of singing the same song, and that's basically that the volatility is here to stay, and that caution's your best approach. If you look at what the gold market's doing here, I mean, we've seen gold prices obviously have a very powerful move in the last couple of months. As a matter of fact, I saw a story that said gold miners just had the best gains in any month going all the way back to 1998 in the midst of the long-term capital management crisis. Bonds have pulled back a little bit in price. The yields have gone up a little bit, but they're still holding the lion's share of the gains in the breakout they had in late January, early February. On a yield basis, 2-year, 10-year Treasury spread is still compressing. It's actually at its lowest since 2007, December 2007 or so. And if it goes just a little bit further, it'll really take out some long-term important levels from 2007. So that's generally a negative sign for economic growth. We're continuing to get bad economic data around the world, particularly in China overnight. We had another round of lousy manufacturing and even service sector reports. Basically, manufacturing activity, their version of the ISM index is at its lowest since 2009. Their services sector index, which is supposed to pick up the slack from manufacturing, is at its lowest since 2008. We're starting to see some cooling in some of the numbers here too, in some of the regional reports, as well as housing yesterday and so on. So, we've had a nice rally in the stock market. We got up to that sort of 1950 level, give or take, in the S&P futures and S&P cash, and tested that, but so far it hasn't really given way. 1960, 1970 hasn't given way on a consistent basis, and that overhead resistance I've been monitoring has still generally held. So to me, this still just looks like a bear market rally within the context of a broader downtrend. So not a heck of a lot has changed my view there. I think that there's a lot of kind of faith. There was a lot of faith and hope going into the G20 meeting that we'd get some big, sort of grand bargain, Plaza Accord type agreement, where everybody gets together, sings Kumbaya, and launches massive deficit spending worldwide, kind of like what we did in 2008, 2009 with the, shovel-ready stimulus. The policymakers have been urging basically countries all over the world to start doing that, but it's falling on deaf ears. The politicians don't have any, there's no political willpower for that here, certainly, and there doesn't appear to be that anywhere else. I mean, Germany came out and said all that would do is zombify the economy, so that's not exactly a ringing endorsement of the of that approach. So, long story short, still seems to be a cautious market, until there's indicators that the longer-term turn in the credit cycle is changing, and I don't see that at all. So, steady as she goes.
Okay, Mike, thanks.
Thank you.
Larry Edelson, Mike Larson just mentioned gold stocks in particular had posted the strongest quarter going way back a couple of decades. Are we in a new bull market here for gold and silver and mining stocks?
Not without a substantial pullback. You don't get numbers like that off of a real bottom per se in any market. That's more evidence of massive short covering. Could mining shares have bottomed? Yeah, they could have. And we will know for sure once we get the pullback, which I expect. Gold, I think, is topped. We might see one new nominal high, and then it should pull back into April, early May, along with mining shares, and that pullback should be quite substantial. They've had a big run-up, both gold and mining shares. So it's always the character of a pullback that is determinative as far as a bull market move goes. So we'll have to see on the pullback how the trading patterns unfold along with the cycles. As far as stocks, global economy, U.S. economy, I agree with Mike all the way around. There's problems everywhere. And the G20 meeting didn't come up with any great ideas, and there's no political will virtually anywhere to make any adjustments, and there's no will on the part of central bankers, really, except for maybe Mario Draghi and the Bank of Japan to do anything on that side. So, the dollar remains in a strong uptrend, which is for one reason I'm skeptical of the gold and mining share rally. And the euro is starting to really erode the 108 level, which will be devastating for the euro. Well, the next drop will be down to 105, then 103, then to parity, and then below. So, the dollar's in a very steady long-term uptrend. It's got another year or so to go. And I think that's really both indicative of the problems in the world, which are a continuing slowdown in the velocity of turnover of money, continual hoarding of money and assets, and deflation. So that said, most commodities, my call on oil looks like it's right on the money. Oil, I say, is bottom. We need to get above really about 37 to say for sure. But there, unlike gold and the mining shares, we have a steady rally back in filling. You don't have a straight-up affair. Straight-up affair is not a sign of a bottom. Never is. It's almost always short covering. So in the case of oil, we don't have a straight-up affair. We have a lot of backing and filling. It's looking really good to me.
All right, thanks, Larry. Appreciate those insights. Kathy Lean, Larry just mentioned the euro. I know you're also bearish on the euro. Do you expect, though, the upcoming ECB meeting to change the current trend at all?
Yes, Mike. We are quite bearish euros. I think you do have to be a little careful with the ECB meeting next week. First of all, March is a huge month. It's a month of action versus inaction from central banks. And we've got a number of central bank meetings that we're watching very closely. The ECB meeting, which is a European Central Bank meeting, is one of them. Of course, we have the Federal Reserve meeting and also the Bank of Japan meeting. So all three meetings, I think, are quite key. Now, with the ECB, what's become very clear, and they've said it very vocally, they're not a central bank that likes to surprise the markets, that they intend to do more. But the question is, will they under or over deliver? If you remember, back in December, the market had these huge expectations of aggressive stimulus by the European Central Bank. And yes, they did deliver a number of changes, but it wasn't enough. I think the market wanted at the time, 5 different items, and they only delivered 2 or 3. So instead of falling, the euro actually rose. So not to say that this is going to happen this time around, but I think that everyone expects the central bank to lower the deposit rates. But so if that's all they do, we may not have a huge drop in the euro off of the European Central Bank decision. Of course, I think that from now until the monetary policy meeting, the euro is still a sell-on rallies. If they under-deliver, I still view that as an opportunity to sell at a higher level because they're under-delivering when the economy needs it the most. But I would be careful right around the monetary policy announcement just because I think it was one of the policymakers, I believe it was Weidman, who said that perhaps the market's expectations are a little ahead of themselves in terms of what they anticipate in March, kind of the same way they had felt in December. So I'm definitely paying attention to those words. Now, inaction could come, will come from the Federal Reserve. And, everyone's talking about buying U.S. dollars. I also agree that, perhaps we may have a little bit more of a U.S. dollar rally after last week's, very strong GDP report. But I think in the grand scheme of things, the Federal Reserve, they're still raising interest rates. But when you get closer to the Federal Reserve meeting, if the dollar's strong, maybe you want to offload some of those positions and look to buy at a lower level. because the Federal Reserve, we think they're going to completely disappoint. And then I think Bank of Japan and the Japanese are the real wild card. Out of the G20 meeting, Mike talked about how everyone was expecting a lot from the G20, and they certainly delivered absolutely nothing. But I think the two parts of the two countries that everyone had anticipated some type of action or pressure on was China and Japan. China, who hosted the G20 meeting, announced this big reserve requirement ratio reduction pretty much 24 or 36 hours after the G20 meeting ended. So I think it was the lack of pressure on specific pressure in China at the G20 meeting was probably more of a face-saving measure, which is very big on the Chinese. And so they announced the reserve requirement ratio reduction the first market day. And I think similar things could happen or could be delivered by the Japanese government. Now, we don't know if they really have the internal will to deliver another round of monetary stimulus, because when they went to negative rates, it kind of completely backfired in their face. So I think, right now what we're looking for is potential fiscal stimulus from Japan. Either way, their data has been terrible, and they really need to step up. And I think March could be, or I hope it will be, a month of action by the Japanese government, either on the monetary or fiscal level. So we're going to be watching that quite closely. The bottom line is this is a big month for the financial markets, and this is a big month for not just the U.S., but many countries around the world, and a big month for Forex. So we're going to be monitoring opportunities quite closely.
All right, thanks, Kathy. Interesting. Boris Schlossberg, anything to add about the March Madness month we have coming up here?
Well, aside from currencies, the other thing that I'm sort of very bullish on right now is actually gold, because of the negative interest rate aspect of all the central banks. And I think, the thing with gold that's been tough is it could be in a runaway market. We've been trying to kind of buy it on a dip, but a true sign of a very strong breakout is it doesn't really give you a lot of dips to buy. And gold has been acting very, very strong. We try to buy it around 1,200 level. It's just not coming into that level at this point. So that's actually acting to me, it's giving me a signal that it's a positive signal for the asset itself. And of course, that's all part of this whole notion that everywhere we look, rates are actually compressing to a negative point, almost anywhere that you place your financial assets in. And that, of course, provides a much, much better fundamental reasons why you want to get long gold at this point.
Okay, we'll certainly watch for those currents here this month. Let's go to David Dukevich. David, what's your observations on markets?
Hey, Mike. Hey, everyone. Well, I'll just continue that gold conversation to start off here. I mean, we did see a really strong move, and there have been a lot of bullish signals for gold that maybe we have seen a bit of a bottom. Last Friday, we got the quote-unquote golden cross, which is when the 50-day moving average crosses above the 200-day moving average. That hasn't happened in, I believe, about 2 years. So that does show some bullish signs for gold. But I do have to agree with Larry's comments that he made that a lot of this move we did see was a big short covering move, and it did kind of move straight up here. So as we do get into that 1250, back to that high of around 1263 range, if we do stall out there, I do expect to see a pullback or at least some sideways trading for a temporary period before we get another thrust higher. So I do think we could see gold drop back. I know Boris just mentioned that 1200 level. I do think that pullback to that level is probably realistic still at this point. Might even be able to dip a little bit further into about the 1167, 1168 range before we see gold firm up again. But we have seen oil, as Larry mentioned, did kind of find a little bit of a bottom here. And as it's moved forward, it has kind of taken its time. It hasn't had that straight parabolic move higher. So I have to agree that I think we are starting to build a much longer-term, firmer base with crude oil. So I do expect to see that. But as he mentioned, that 37, 38 level on crude oil is important. We do need to get there and probably break and hold that level to really get that thrust higher to know that that bottom is in. Natural gas did pull back. It's trading back at the lows we saw in December, which has surprised me a bit. I didn't think we'd get back to these levels. But we're holding right there now, so we're at a critical point. If we can hold at these levels and move forward, we are starting to head into a more seasonally positive time period for natural gas. So we could maybe move ourselves higher from these levels. So it might be time that you can start dipping your toes into a natural gas position, but you do have to be careful because if we break lower, we could continue to just see this fall down again. The markets themselves have been in 2016 have really been in a trading range more than anything else. With that 1950 on the high side, and we've kind of seen a double bottom here around that 1810 to 1820 level. So it's a decent range on the S&P of that 140, 130 point level, but we haven't been able to break significantly one way or another. So until we get through one of those levels, I think it's going to be a tough market. When you get to that 1950 level, it might be time to lighten up on positions. Same when you get down into the low 1800 level, that's the time that maybe you can start to add some long positions. But as we said, for 2 months, we've kind of been bouncing around this range, which has been a tough market to be in right now.
Indeed, it has. Very volatile. Thanks for the comments. Mandeep Rai, let's get your insights.
Hey, good morning, Mike. Good morning, everyone. So the market seems to be stabilizing somewhat around better economic data. The turn in the market also coincided with the Citi U.S. Economic Surprise Index turning back to the upside. And that's just a gauge of whether the data is missing or beating expectations, and it's showing more beats than misses. So from an economic standpoint, job gains have been steady. Inflation is kind of moving closer towards the Fed's target, and consumer spending, which is the largest portion of GDP, rose in January for the highest pace in about 8 months. Those are some good points. It's not all good. The Chicago PMI on Monday was terrible. We saw production down sharply, backlogs are falling, and prices paid are rising. And the only good part of that number was that the new orders held above the 50 level for now. But the market shrugged it off, and it's because the preponderance of the evidence is showing that data is better. And we'll get a fresh look this week. We'll have the ISM PMI numbers. We will have the usual inventory numbers for oil and for gas, and then Friday we'll get the jobs numbers for February. So those are all going to be worth looking at. And in terms of earnings numbers, earnings season, we've seen the dollar do its damage to the large cap sales and earnings, but with the market around a fair value of around 15.5 times forward earnings, given the backdrop of low interest rates, it's still holding steady. And the decline in earnings season is expected to slow for the second quarter, so we're going to get less negative, hopefully, for the second quarter. Right now, we're on pace for a 3.5% decline in earnings and a similar decline in sales. And then hopefully, analysts are looking for a turnaround in the third quarter to be back in the green. So expectations are being pushed out for green towards the back half of this year. But that the market is kind of holding steady unless there's any revisions or anything that kind of unexpectedly causes those to decline further. Then I would expect markets to kind of hold here, at least stabilize. What was interesting was if you look at the tape yesterday, in the first half of yesterday, you started to see the financials and the biotechs be the leaders to the downside, and that could be potentially kind of leading off of some of the rhetoric or some of the the election cycle kind of impacting markets to kind of see what the impacts would be of whatever candidates are in the lead and how that would affect Wall Street. And you're starting to see the rhetoric around drug pricing and around fat cat Wall Street bankers become easy targets, and you started to see those sectors be more kind of taken out to the woodshed faster than the others yesterday in the first half, and kind of led the other sectors down towards the second half. So that's kind of some noise in the markets in general. But it's kind of it's what we're up against, is what folks are seeing and digesting and kind of reacting to, correctly or incorrectly. But that seems to be there. Now, in general, we're also still following crude oil prices, and sometimes that correlation is stronger than others. But excuse me, recently it has been stronger, and it leads me to believe that the ripple effects of oil prices are hurting equities, and obviously, the large determinant of that, and obviously it's from an earnings and debt repayment perspective. Earnings have dropped by 70% in the oil sector, in the energy space, but that also implicates other sectors and industry groups like financials. So now that we've gotten what looks like a bit of a double bottom, and we've had some favorable supply news with crude stocks falling, starting to dip outside of the U.S., and China actually saw an increase in its import take by 7.5 billion barrels in February. So you're starting to see some more fundamental supply side type of oil move related activity here, which is good. Oil is still very tricky. If you remember, back in the summer of last year, oil was nearing $60, and it kind of broke through $60. So that was the level that a lot of the U.S. exploration and production companies actually came on and said, hey, listen, when we get to 60, 65, that's when production comes back online. We have wells that are ready. They have been put aside for, because of low oil prices, but that's when we start to pump these things again. And that provided the ceiling in oil prices. Now, with earnings coming out for oil companies, EOG Resources, which is one of the considered one of the most efficient West Texas producers, said that number is now $40. They want to earn a 30% return on their oil production, and they get that at $40. So it kind of coincides with some of the other analysts on this call were saying $37, $38 seems to be the top side for oil near term. And that could be, again, what we saw last year, the ceiling for oil prices, especially if that is the level where not only EOG, but a lot of the other E&P companies come back online as well. So that's worth watching as well. So watch the economic data this week. So far, it's been more good than bad. And watch the ECB for next week. The ECB has been able to prop up the market with their QE and the quantitative speaking so far, and a big reaction is expected. Watch to the downside if it underwhelms. But if we do get the upside, I think 2K in the S&P near term, but longer term headwinds still remain. I'm more short term bullish, but it's still being cautious and not really playing this from a buy and hold perspective, more so a trader getting in on the dips and trying to sell the rips. And that's where I'm at.
All right, thanks, Mandeep. Good insights. Appreciate it.
You got it.
Well, that wraps things up for this week's Squawk Call. Great insights, ladies and gentlemen. Thank you, one and all. And be sure to tune in again next week. Until then, I'm Mike Bernick for Money and Markets. Good investing.